What's up, everybody? Welcome to the Emerging Manager Growth Show. I'm joined with my partner, Andrew O'Shea. Andrew and I have worked together since 2014 at Dakota. And for those of you who don't know us, so our primary business is we're third-party marketers for a variety of emerging managers. So we've been working with emerging managers since 2006. And Andrew, we're going to go through today a lot of detail, right, around what you should be thinking about as an emerging manager. And our whole goal is to provide you information so you can do more with less. Maybe do you just want to define an emerging manager for us before we get into it?
Yeah, emerging manager means different things to different people, but clearly you're a manager that's in the early evolution of your life cycle with a limited track record and limited assets.
And so today, the theme for episode 3 is consultants. Andrew and I have compiled one of the most detailed looks at how you approach emerging manager programs within consultants. And that's what we're going to cover today. I think importantly, as you start to hear, as I'm going to tee Andrew up for a lot of this information, all the information that you're going to see today is inside of Dakota Marketplace, but we're going to share a lot and the exact tips and techniques for how you should go about approaching consultings for an emerging manager. Now, Andrew, you just want to talk a little bit about the Dakota way, because I think as we're going through this, it does come down to your approach, your sales process, in order to be very effective as an emerging manager, because you have to find a way to do more with less. You just want to talk just about the Dakota way a little bit, city scheduling and what we do?
Yeah, of course. So our methodology, it's obviously a huge universe. When you're an emerging manager, there's a huge target market to call on. The key is to figure out, how do I make the most out of my efforts in terms of prospects I'm calling on that buy what I sell, as well as making sure I'm covering that large universe. And so one of the ways we do that through a defined process at Dakota is called city scheduling. It's a very simple concept, but we put 3 to 4 cities out on the calendar, out anywhere from 4 to 6 weeks. And we begin scheduling meetings with qualified allocators in those cities.
That's for each salesperson at Dakota.
Exactly.
Right, so we might have 10 to 15 cities on the calendar at any given time, which gives you a purpose and a reason to reach out. And we're going to talk about that in the second half of the show.
Of course, and a call to action is always easier for an allocator to digest your information, understand this person's asking for a meeting, am I interested or not in this moment, versus a bunch of collateral that they have to shift through and decide if they're interested to meet.
And so you're going to see as you go through this show, we have a very defined way of working. We hold ourselves very accountable. I do have to go through a few housekeeping issues. So for those of you that are new to the show, the second half of the show is the same. It's our guide to growth. We go through the 5 things that we believe an emerging manager should be doing every day that are almost free, that has maximum impact. If this is not your first time on the show, then you're just going to get a rerun. So how we've designed the show is for the first 30 minutes to be original content around one key theme. Today it's consultants, consulting firms that have emerging manager programs. Last week we did RAs. So like I said, I'm going to have a little attention thing here. I don't want to have you be disappointed, because at 1:30 it's always going to be the same for all our new listeners. What we believe are the exact things that you should be doing to have success fundraising. So with that, Osh, you want to? Lastly, we have Dakota Cocktails next week in West Palm Beach, November 16th. We have Richmond, November 29th. We have New York City, the 1st of December. And in conjunction with AMSI, December 15th, we have our Christmas party here in Philadelphia on the 3rd floor of our office. So with that, Osh, let's kick it off with the myths around calling on consultants. And I think this is really important if we're giving proper guidance for how we think you should go about it.
Yeah, sure. One of the most common myths we hear out there is, I don't want to go to market to the consultants yet because I don't have a 3-year track record or the amount of AUM that we're looking for. Certainly, many consultants will want to see a 3-year track record, but in that case, they will still want to meet with you prior to reaching those milestones, so they get an understanding of your strategy, what your differentiation is, and so when you do hit those milestones, they can act quickly because they've started a file on you, they've started their due diligence. So that being said, you want to make sure you have your strategy in place for the future. You don't want to be changing your process or the type of strategy you're offering. But once you have that tight, you really want to bring your strategy to market with an understanding that you're planting the seeds for the future.
And as we all know, fundraising success comes down to familiarity with a particular investment strategy. If you're going to wait 3 years for someone to get familiar, right, you might be 1 or 2, 3 years behind. So, please, questions on the right side of your screen, fire in the questions. The last call that we did, we had 23. We're going to get to them all. So, all right, myth number 2.
Yeah, this is on the opposite end of the spectrum. Sometimes we hear from managers, I'm only going to cover, we're a small team, so I'm only going to cover the key gatekeepers since we don't have distribution. So I'm going to spend all my time on the consultants. As you know, you can die on the vine calling on the consultants. It's really an R&D exercise and can be a huge channel for you over time, but it takes many, many years to actually see assets. And so make sure you're working in the consultants with all your city scheduling, but also covering the other channels that are in Marketplace as well.
And what we're going to do inside of Marketplace, there's over 375 firms that we've identified that have an emerging manager program. We have 24 consulting firms that we know have an emerging manager program, and that information is in Dakota Marketplace. It's our recommendation that you get into a sales cycle with each one of those, just introductory call, get to know you. And Osh, why don't we just talk about for a brief moment, we get a lot of questions about, are you traveling? Are people taking meetings? And it's basically resounding yes. You just want to talk about the travel and how receptive allocators are, consultants in particular, to a face-to-face meeting.
Yes, and we're fully back on our side. I know there's certainly a lot of efficiencies that Zoom's brought into the sales process, but we have seen allocators coming back on site. We've seen them taking meetings back in their offices or outside of their offices, but everyone's been eager to get back to their process of being in the firm, feeling the culture, getting to meet some of the analysts face to face. So allocators are open taking meetings.
And what ends up happening, Zoom, very difficult to build a relationship, body language, everything. Having off-the-cuff conversations, much more natural in a face-to-face meeting.
Especially if you're an emerging manager and a founder, it's your passion. You've started your investment firm because of a very specific expertise or belief, and they want to hear that directly from you, and that only comes through best in a face-to-face meeting.
So that's a topic we're going to get to, but let's just hit it right now. Osh, that's another myth, right? I mean, it's so important, okay, to get your portfolio manager on the road, okay, in front of these allocators. They want to meet the wizard. Can we just talk about that a little bit? Because we see a lot of people reluctant to get portfolio managers out on the road for a variety of reasons. Let's just debunk that myth right now.
Yeah, for sure. And firms really want to get to know the founder, obviously, but we do hear from some emerging managers that I'm only going to focus the PM's time on the portfolio. I'll have my analysts go do the meetings. We haven't found that to be productive. And so you have to embrace the full process of marketing and getting out on the road. But that being said, it will require training with your PM around messaging, the types of questions you're going to be asked, how to say the short answer first. So there's training you can do as a professional salesperson with your PM, but understand as long as they're high quality meetings that you can accelerate the sales cycle by getting the PM in front of the allocator more quickly.
Right, great. And so let's talk about if I get approved, will I get assets? Because that's a question that comes up quite a bit. If you actually go through the process, you get approved, are you guaranteed assets?
Absolutely not. To some extent, you will be put in searches, but there's also what we call the second sale aspect of working with these consultants, which is getting to know many of the field consultants as well. So you're not only establishing relationships with the field consultants, but also reaching out to the institutional clients that use that consultant as well. They're very receptive to taking meetings directly from you, not just always working through their consultant.
And especially if they've taken the time to approve you, then they would like to see you get into portfolios. Mm-hmm. But it is a process, and we've seen it with Cambridge and NEPC, with Edgewood. I mean, it is a process.
Correct, and it can take years. In many instances, we've seen 5+ years where we've been approved, and then all of a sudden, the tide shifts back towards your strategy, things change, and all of a sudden you can garner a lot of assets. But don't get discouraged and don't expect that all the money is going to start flowing in just because you got approved or rated at said consultant.
Yeah, the key goal is just to get in front of them. Like I said, we have 24 consulting firms that have emerging manager programs in our database. You just want to cover them all, get into a sales cycle. So with that, why don't we just kick it off, Ocean, start talking about some of the consultants that you have an emerging manager program.
Yes, for sure. And what we're going to talk about is consultants more broadly, but when I think about emerging managers, I think about three different buckets. The first would be emerging manager consultants. The second would be larger consultants that have emerging manager programs within their practice. And the third would be OCIO groups that have more discretionary capabilities. So the first topic we'll cover is emerging manager consultants. Really, their entire business is devoted to underwriting, sourcing, and providing access to emerging managers, both across alternatives as well as public markets. Many of the public plans hire these underlying consultants. We had exponents on as a guest allocator from an emerging manager consultant earlier in the last show. But these examples would include, in addition to exponents like an Addix Asset Management, Legato, Bivium Capital out of San Francisco, Leading Edge, and then Stable Asset Management from the alternative side. In addition to pure emerging manager programs, these consultants also will be focused on minority-owned firms as well. That's a big part of their process additionally, so that's important to keep in mind as well. Other key considerations when calling on these emerging manager consultants is that fees are likely to be heavily negotiated. So be prepared to have that discussion in terms of what you would be comfortable with in terms of fees initially, but also many of them will ask for future capacity at said fees. So that's something to be prepared for going into the conversation with those consultants. But also be willing to be flexible on the vehicle type that you offer your strategy. If you have started the firm as an LP in a private fund format, but the emerging manager consultant comes to you, they might ask for your portfolio in a separately managed account or a CIT or a different type of vehicle. So be prepared to offer flexibility on future vehicles as well as fees on structure.
Gotcha. So one question just came in. Do you think lone wolf placement agents are useful to top off an early stage VC fund in the $50 to $100 million range? I would say yes, if they're going to cover a specific number of names for you. That can be very effective if they have those relationships. Any thoughts on that?
Yeah, and I would look into their prior experience in venture because that's a nuanced channel. Clearly, if they have depth of experience in that channel, that they could move more quickly in terms of targeting the highest probability buyers for your strategy.
Great. And another question came up. It's kind of, we've just talked about it, but is it best to approach the consulting firm first or their institutional client, or approach them both in tandem?
I argue both in tandem for two reasons. One, a lot of times you don't know how much they might be using the consultant, but also have the ability to underwrite their own ideas. And so in certain asset classes, they might be comfortable sourcing themselves. They might use a consultant for operational due diligence once they source the idea. So you never know the extent of that relationship. So I would always work them in tandem.
Yeah, and I think it would be poor to assume that people know your strategy or how they're going to react to your strategy. So you just have to get it in front of them, because a lot of times you have more active board members if you do approach a trustee, or if you approach the direct contact, the analyst at a potential plan. You don't know what they're thinking about until you actually make that call and how they're going to react, right? So the only way to solve the problem is to call and talk to both in tandem.
Yeah, and in many cases, we've called on the account directly, and they've introduced us on email directly to the research contact at the consultant, showing they have interest in learning more about the strategy, but start the process with the consultant. So that's another benefit.
Right, and then Anthony asked, how do we figure out the pension endowments that are using a particular consultant? That's easy. All that information's in Dakota Marketplace, right down to the field consultant, to the public plan, to the main consultant, to the analyst, everything. That's all in Dakota Marketplace and cross-referenced.
Yep.
And it's complete and up to date. All right, let's start moving on to your next section of consultants.
Yes, and so this is, many of these are the larger consultants, but they have defined programs dedicated to emerging managers. Makita is a big one. They work with a lot of the public plans, but they have billions of dollars they've committed over the years to emerging manager programs, both on a discretionary and non-discretionary discretionary basis. They have 2 emerging manager days per year. Their last one was in late October, where you can apply essentially. They have 3 days worth of meetings with emerging managers, and it's a great way to get on their radar screen.
And remember, another reason, we're all in sales, but getting face-to-face, going to these meetings, all of these consulting firms talk, people talk in the industry, they share ideas. So you don't know, maybe that emerging manager program that you're approaching, maybe they're not going to take action quickly on the strategy, but they might end up having a conversation with a friend, sharing the idea, and next thing you know, you're involved in another consultant. So it really pays to be out, going to these different conferences for emerging managers.
Exactly. Another large global consultant would be Willis Towers Watson. They've been very active historically within emerging managers, particularly for their discretionary business, or what they call the delegated business, where they have commingled funds themselves. We'll try to find earlier stage managers in capacity constrained asset classes where they can allocate directly. Again, their client base is so large and vast, they really want to start that conversation early on in their life cycle. But Willis Towers Watson, very creative in how they think about working with emerging managers. They may even come to you and say, if you're a long short manager, they may do analysis and come to you and say, we only want your short portion of the book. So thinking about them as an interesting target for discretionary assets in an emerging manager program as well is very important. StepStone, historically, for those who offer real estate strategies, have adopted emerging managers quite extensively, but that's more specific to alts and real estate. Others would be like a Mercer. Obviously, everyone knows Mercer, but they do have a defined emerging manager program. Important just to start getting your information in their database as early as you can.
Which is really, the whole database thing is very important. Getting the information in there, getting it updated. And then we have now compiled a list of all emerging manager conferences in Dakota Marketplace as well. So just trying to be very useful to our members in terms of aggregating that information so you can see exactly what is up and coming.
Another one that's interesting, because a lot of these larger consultants I mentioned earlier touch a lot of the big pension space, but Crucial Partners out of New York City, they work with a lot of foundation and endowments, so they tend to be more biased towards emerging managers as well. And then Russell Investments, believe it or not, there's some large sub-advisory opportunities with Russell as well. So again, they have defined opportunities for emerging managers specifically for many of their sub-advisory mandates, both on the alternatives and public market side. So what are the key considerations thinking about these groups? Begin updating the database early, as I mentioned. Callan's another important manager to make sure you have your information in. Understand what the discretionary components are of these underlying consultants. And then, as we mentioned earlier, do not limit your marketing activities only to these consultants.
And in general, as we all know, the RA channel, and we really believe the consultant channel can be a great place to start, just getting everything in, but these are much longer sales cycles. As you know, RAs and multifamily offices generally have discretion, and they are very willing. This isn't the topic about RAs, but in terms of your sales strategy, if you're wondering, how do I balance my time? You have to be covering the leading RAs, and now we do have a really good list tagged in terms of what RAs really favor emerging managers in our database. But I think that's critical that you're staying in front of the RAs, because they can make, like we've already seen it. I mean, we just took on working with a firm called Spruce, and they do construction loans, 14.5% net, and it's in a mortgage REIT. They're on their second fund. The first call, because we just started working with them, spectacular firm, 3 weeks ago. The first sales call you made, right, was to an RAA, right? They're already coming on site in November, and they might make an allocation because the strategy is such high quality, but they're just about $1 billion AUM, so they're definitely an emerging manager. But that's pretty good evidence to how quickly RAs can move if they like the strategy.
Yep, exactly.
So really important consideration. And all we try to do with the RAs is kind of chip away at them city by city, introducing ourselves. So like I said, we covered a lot of that in the last show, but this is consultant. So On to the third category, OCIOs.
Yep, OCIOs, consultants, they all blend together these days, but we bring these up because they might not have as much definition around emerging managers in their programs, but it's more aligned with their philosophy, and that they believe finding managers earlier when they're hungrier, and that evolution of their growth cycle actually adds to performance. So they might not say we only allocate to emerging managers or we only allocate to large managers, but historically these types of firms have liked finding smaller managers, and that tends to be more of the OCIO groups, which we'll highlight a couple. We did have Brad Long on from Fiducian Advisors on our Dakota Live call.
Key thing there is 65 RA clients and counting.
Exactly.
It's a huge connectivity to the RA channel through Fiducian.
And they love boutique managers on the public market side, but I would say especially on their private equity programs, they like finding fund ones, fund twos, smaller buyout funds. So that's more on their alternative side of the business. But broadly, I think they've embraced the boutique manager there at Fiducian.
And if you are, obviously, if you're on the call here, you're an emerging manager. Also in our database, just because most of you are members that are on this show, we have put a new field in called LP Power User. So we've handcrafted and identified the RAs that are LP Power Users. So if you have an LP, a private fund structure, right on the investment preferences, you can see that. And so we're trying to be as useful as we possibly can around curating the list of who invests in LPs.
Exactly.
From an RA perspective.
And then you have a number of others that offer discretionary services. You could argue these are an RIA or a consultant. They work with institutional clients. We tend to have them coded as consultants, but like the TIFs of the world, Global Endowment Management, Strategic Investment Group, Investure, Cornerstone, Edge Hill Endowment Partners, Valence 8, which just was created from the former CIO of Partners Capital. These are all groups that are looking for small and interesting emerging managers. And the key consideration there is the opportunity could be quite large, but it's also probably not as, the opportunities aren't as open, if you will, meaning that you have one slot in their portfolio and they're going to get their highest conviction manager into the portfolio versus like a broader select list.
And by the way, we're going through our show notes right now. We will absolutely share these with you after the call.
Absolutely. And then typically people ask us a lot, what if I can't reference X track record at the prior firm I was with? And the one comment I would have on that is, if you're an analyst coming from a prior well-known firm, the allocators tended to not put a ton of weight on whether they can attribute the track record or not to you. It's more the qualitative aspects they want to understand into what made you decide to leave this firm and start your own firm. What did you learn at your last firm that you're applying to your new process? So it's not, if it's not, you can't share a previous track record, it's definitely not the end of the world, but it certainly helps if the allocator you're speaking to has familiarity with the previous firm that PM was with.
Good. So this has been a very good overview of the, as we kind of close out. So if there's any questions about consultants and emerging manager programs within consultants, please fire them into the chat. We're just going to close out with talking about different pensions at different conferences, et cetera, that we think would be useful to go to. Osh, you want to run through those?
Yeah, sure. I mentioned earlier, Makita has two emerging manager meeting days per year. We will make sure those are in Marketplace as well. We highlight a few of the pensions in Marketplace as well that have emerging manager programs, Lacera, CalPERS, State of Maryland as an example. And then there are specific by asset class emerging managers, so like a Grosvenor, they would be more alts, no opportunity for public markets managers, but they would be one that adopts early funds as well on the alternative side. And then there's these quasi-platforms, access platforms, KSI Capital, what do you call them? Are they a platform? Are they a consultant? But at the end of the day, they're providing research and underwriting to managers. One interesting one we've come across is called Gridline out of Atlanta. They're doing a lot in the alternative space looking more specifically at emerging managers as well.
Great. So this has been our attempt, if you will, of really in 25 minutes bringing together everything about emerging managers as it relates to consultants. We'll follow up with the call notes, and so you'll have exactly what we went through. And this is the time where we're going to transition. This is always going to be the same on every show, but these are the tips and techniques that our team uses on a daily basis so an emerging manager can basically do more with less. Okay, and I just want to make sure everyone knows this will be a repeat, but it's live, so you can ask questions. We can go through it. Yes, we will be sharing the list of consultants that we just covered. And okay, this is a really good question. And Brody, you're funny. Clearly this is an industry built around personal relationships, and you have emphasized in-person meetings. Is there a role for emails for emerging managers, and if so, what is their optimal use? Well, I'm glad you said that because we're about to cover that. This is what I think about personal relationships. I think over time, they're very useful, okay, but at the end of the day, the due diligence analyst doesn't, it's nice to have a nice relationship, but they're into finding great investment ideas for their clients. That's, at the end of the day, they're trying to find the best investment ideas. That's why it's so imperative that we get in front of them. And Brody, how do you define an emerging manager? I hate to say it, it's different sizes and shapes, but I think it's I always think of under 5 billion.
Yep.
But as we heard from Exponents, that they actually hired an emerging manager, they got up to 10 billion and they had to fire them.
Right.
So it's kind of that 5 to 10 billion is kind of the top line. Is that fair in terms of defining?
I think the simplest way to put it is, not necessarily by asset size, but how long have you been in the market? What types? Are you a single strategy firm, or are you a big asset manager that just launched a new strategy? They wouldn't view that as an emerging manager, but typically I would say inside of 5 years track record, anywhere sub 2 billion AUM would be a broad generalization.
Yep, and back to the email question. So the biggest issue that emerging managers have, and listen, I don't like the recession word that much and all that stuff. We have to keep doing our job, but everybody's being asked today to do more with less. That's what we're going to cover over the next 20 minutes is how, what can you do very inexpensively, but huge impact. And the first, the solution is to do more with less. So first off, this is very important because it just comes down to product market fit.
Correct.
Back to the example of the consultants, you have to have a balance if you're an emerging manager, especially if you have a short track record and lower AUM. You have to have a balance absolutely between RIAs and those consulting firms and those institutional accounts. But so writing down a sales plan. Now, this is a little bit, as we talk about, because every time we onboard a manager, we have to write up a business plan. We go through the business plan, and then, of course, there's reporting, which is critical. Mm-hmm. You just want to talk about that?
Yep. So we establish and bring a strategy to market, and typically we'll assess where are the best near-term opportunities, where are the long-term opportunities, like the consultants that we need to make sure we're covering. And then we like to manage expectations with the portfolio managers, which is typically not around assets, but around activity and results around activity. And so what we tend to do is we report in terms of both meetings scheduled on the calendar going forward, meetings completed over the past month, and then we establish over time a pipeline against that report and communicate with them frequently.
Yes, and the sales plan isn't really about the sales plan, okay? It's about all of our careers, okay, and protecting our careers. The way that you do that is if you write down a sales plan, you sit down with the PM has an expectation that you're going to raise up here, we're going to raise up here, and reality is probably here. We want to be the dog, not the tail. The way you accomplish that goal is very simple. Write down the sales plan, agree on what success looks like, which shouldn't be about fundraising money, it should be about activity against the channel and getting in sales cycles. So it'd be like goal number one, get into a sales cycle with the top 24, if you will, in our database, emerging manager programs, right? That would be one goal. Next would be cover the top 100 RAs, get into a sales cycle and introduce the strategy to those top 100 RAs. Then, when you do your reporting, right? There's no like, hey, where are you? What are you doing? And you're either going to want to report once a week or once every other week, and then you don't get caught off guard, but with unrealistic expectations with a PM.
Yep. And we always like to say it takes at least 3 to 5 meetings to make a sale. Typical sales cycle, at least 9 months on the fast end. So making sure they're embracing the entire length of the process that it takes.
Right. And remember, writing a sales plan is free, but it's the best career protection in the world because you can keep coming back that you both agreed that this is what you were going to do and that you're acting according to the plan. Most salespeople that I've talked to don't do it. We love doing it because we don't want to get those random phone calls from people like, where are you, what are you doing, where are the assets and all that. So that's what we solve for that problem. Now the next thing of how we solve for the problem, as Andrew said earlier, is around city scheduling. And I believe when we instituted this in 2012, I needed to have something where when these young guys, they're a little bit older now, when they were younger, when they came through our doors, they needed a focus each day. And so our entire database is built around city scheduling. You just want to talk about how we do it? I know it sounds like a simple concept. I know we all do it, but time flies and you always want to have 3 to 5 cities that you're scheduling for at any given time. That ends up and we'll get on the exact email that you want to be sending. We built Dakota Marketplace to literally solve for the city scheduling problem.
Yeah, exactly. It just takes a very large addressable market and allows you to focus your time and energy on one specific metro area. It has a lot of benefits, but one would be always uncovering new relationships or new pools of capital that you haven't had the opportunity to connect with before. So we put 5 meeting times on the calendar, and we go to work to schedule against those 5 times. You want to give yourself at least 4 to 6 weeks to establish your schedule, to do follow-up emails, and then typically the trip would come to fruition, and you always want to be filling in where you can, but you want to have it be a rolling cycle where you always have 2 to 3 on the calendar that you're scheduling for, and next thing you know, you've covered all NFL cities,
right,
as we call them.
Right. And we have a sales training program called Rainmaker, and I did that because it should be ironic, right? I don't believe there's any rainmakers, right? I believe the best salespeople follow a very detailed process to go from an average salesperson of 1x to 2x to 5x to 10x. And everything we're going through is effectively to keep you focused and save you a lot of time, but follow a process. And if you follow this process of getting in front of qualified buyers on a consistent basis, and if you can do it more times than the average person, that's how you can multiply your effectiveness. And that's everything that we've done. And as you can tell, I love sales and I'm so into sales process because if you follow the process, it works. Mm-hmm. And so that's city scheduling. And it's been an unbelievable thing for our business. That's just the contacts within the database. All right. One of the most favorite topics that we hear. What emails do you send? What are the most effective emails to send to get meetings? But before I do that, can a manager be emerging too long? No. Even if you have a 10-year track record, if you're smaller, right? Absolutely not. How does a platform like iCapital get paid from fund managers? Do they charge an annual fee to be part of the platform or charge a success fee? There's really there's in certain cases there's basis points depending upon what platform at iCapital you're on. Others it's just a monthly fee like a SaaS platform. When do you provide third-party marketing services to a manager? Are you exclusive? Yes, we will be exclusive to that asset class if you're asking that from us. Will you provide those services to a competitive manager? No, we can't do that. So if we wouldn't have 2 large cap growth managers from a third-party marketing standpoint. How do you leverage the knowledge of who is allocating to a specific strategy? That's probably referencing if that's what you mean by a consultant. So what consultants are allocating to a certain strategy, that's just inside the meetings and asking the questions, right?
Exactly.
Yeah.
And with the consultants are actually an easier, cleaner channel to call on because the consultants have, in most cases, dedicated analysts by asset class.
Yeah.
And so their job, if you're a small cap value analyst at said consultant, your job is to know the small cap value space cold. RIAs, it might be a little trickier because they're more generalists. But for the consultants, you really just work through that feedback with the covering analyst, which is in Marketplace.
So this is what I find so ironic about the investment business. So we all work for one amazingly smart women and men that manage all these different strategies. And they are all extremely well educated. Ivy League schools, Stanford, all of that, okay? The problem with that is that in order to raise money, you have to get a face-to-face meeting. In order to get a face-to-face meeting, you have to send an email, right? In order for someone to open your email, you have to have a catchy subject line that's very clear what your intent is. And then in the body of the email, you have to have 1 to 2 sentences to really pack the punch, to want them to be like, oh, I want to take this meeting. Then you have to have a clear call to action. One takeaway that we're going to send to you, just so you know, it's not just my opinion. There's a pretty famous guy named Diamandis, okay? And he just sent on this blog, I got it Monday or Friday or whatever, and he said how to write the perfect email. And it's going to coincide with this, but we have our own custom thing that we've done here. So number one, if you're going to send an email that you want to get open, you have to be very clear in the subject line of what it's all about. And for the most part, what we're doing is we're just trying to get the email to get the meeting. We're not trying to make a sale in the email. And when we had Exponents on, he loved this so much, and he goes, please don't talk about performance in your email. So if you got meeting request, date and time, body of the email, max 2 lines, preferably 1 line. You're gonna have to give this a lot of thought. So this is, you have to end up being very thoughtful and creative about packing as much information in a short period of time, if you will, in the one sentence. So they look at it and they're like, all right, I know they want a meeting. Is it worth the time? So Andrew, why don't you tell us, because we live and die by email meeting requests, and we give a lot of thought to the body of the email, which is really 1 to 2 lines max.
Yeah, exactly. It actually takes more effort to write a very short email than it does a very long email if you're trying to pack as much as you can. But the key also is do the work for the analyst, not just obviously presenting what they should care about, but can you meet on September 12th at
Yes.
1 p.m. East?
So even though once you've done the body, right, 1 to 2 sentences, and it should be so clear and compelling about who you are and what you do and why it would make sense to meet with you, right? Because it could be, hey, we just completed Fund 1 and it's been very successful. We're on to Fund 2, and then you state the specific strategy, and we'd love to introduce the strategy to you. And then what most people don't do, I just got another email today, somebody wanted to meet with me about software or something like that, and they didn't give a clear date and time. So you have to have a clear call to action, which is, as you can see there, simply say, can you meet at 1 p.m. on 9/12? And tell us what that means about making it easy for the buyer to book the meeting.
Well, now they can go look at their schedule and say, am I free at 1 p.m. versus, hey, let me know if you're available to meet. And then they have to figure out a time. It just takes a couple of steps out of it.
Yeah.
A great book on this topic, which Guy had me read before I joined Dakota, is a book called Brief.
Yes.
It's a very good book and talks a lot about this concept.
So bottom line is, it's clear subject line, what the email is all about, right, which is a meeting request. Be very tight with the body, and then a clear call to action. And I always say that it really has to pass the JP Morgan private bank email, which is, Dear Guy, I'm very sorry, but your 109-year-old aunt died, but she left you $1 million. Can you get back to me with the time we can talk, or can you talk at 1 p.m. to give me your wiring instructions, right? It has to kind of be like, what would you write where you say to one of your colleagues, hey, what body of the email would you respond most to? Like, what would I need to say in that email? We give a lot of thought to this because we're essentially held at gunpoint to an email to do our jobs, right? If we can't send the right emails and book meetings, we can't raise money. That's why we give so much thought to these emails. Okay, now, as we're closing in, we have 2 more things. So when I think of fundraising, and I think of, we put all this time, money, and energy into city scheduling, our emails, booking the day in Cincinnati, okay? If you go there, okay, and you get to the meeting and either you're not prepared, you haven't done your research, you're not prepared with the 15 to 20 questions that you know, right, that due diligence analyst wants answers to. And maybe you could talk about that, because it is this is kind of the opening. This is preparation and really making sure in your 2-minute opening remarks that you're nailing those things so you don't make the due diligence analysts have to ask or pull all that information out of you so you can get to the heart of the conversation.
Exactly. We like to call it de-risking the conversation, which is sort of establishing your credibility on the front end by anticipating a number of the questions that they will ask. When was the firm founded? The number of employees, AUM, things that you don't want to wax on about in terms of the meat of the presentation, but that you can quickly cover within 2 minutes, and so the analyst can quickly get centered on what matters most, which is your differentiation into the investment strategy.
Right, and I think what Andrew just said there, our goal is always to get the analysts centered, so we want to tell them exactly what they want to hear so they can focus on our investment strategy and sort of take that other stuff off the table and de-risk the conversation, because as you're speaking in those opening remarks, their brain is literally going like, oh, I don't see, geez, that makes me uncomfortable. But all of a sudden, if you do it properly, you're essentially building massive confidence, you and your firm and the strategy, and then it can turn to what is really important, which is the heart. And let's just talk about that. We talk about this a lot. The main goal, because we all know PMs, okay, and we want to run the meeting, can wax on and on and on. And we really talk a lot about getting into a conversation and Q&A as quickly as possible.
Exactly, and I think you want to establish those front-end comments to de-risk the conversation around the firm and the people and the process, but you want it to be a dialogue from there. You don't want to have the PM start the meeting and just start presenting the strategy, right? You want them to be engaged because they likely already have things they want to talk about coming into the meeting, and so you want to put that back to them as soon as possible, but you also want to make sure you frame it.
So now there are 2 things that you have to do to close a meeting. So the opening, which we love, is really focusing on those 15 to 20 questions so you can get into a conversation, Q&A about the strategy. Now, this isn't an extensive Rainmaker training, so we're kind of just covering this quickly. But the 2 things that you have to do to close out a meeting is, number 1, ask the question around, hey, do you see yourself, would you allocate to this type of investment strategy? I realize that you want to cover it, you'd like to know that on the front end, but a lot of times you book the meeting, the person takes the meeting, and you go all the way through. You need to kind of know what the goods are, right? Could there potentially be a fit? Okay. Once they say yes, we would, then you have to ask the next question, because you don't want to go back to the office and have someone say, hey, Andrew, how was the meeting? Right? And you don't say great meeting, right? We ban great meeting. You can't say great meeting. So you just simply have to ask, hey, I know you guys invest in strategies like ours. Do you see yourself doing a search in the next 12 months? Do you think it's possible to make our 3/31/23 close? And then it's a very fair question to ask, and you're going to save yourself so much time. And you can't be afraid to get that, because a lot of people come back and say, no, it's all good. Well, why is it all good, right? You got to ask the tough questions. It's going to save you so much time, and probably then also create opportunity, because they're not going to probably put that forth.
Right. And we like to get the quick no's as well. If there's not an opportunity, move on.
Exactly. So we have 2 more questions. Is basing your sales hook on momentum likely to backfire in alts markets where decision makers want longer time frames to commit to funds? No. The key thing in fundraising, right, is getting in front of qualified buyers. The time frame will take care of itself. Our job is to make sure we're getting, so you think about it from a prioritization standpoint. If you're an emerging manager, if you have an LP, whatever it might be, there's going to be your top primary buyers of that strategy. So for instance, if you're on Fund 3 and you're private equity, you're going to be consultants in public pension funds, then foundations and endowments, right? Maybe sprinkle in potentially insurance companies. If you're a mutual fund or a separate account, you're going to want to be in front of as many RAs as you can find, right, that are qualified, get into a sales cycle, and then make sure you're covered at all the banks and broker-dealers at the home office, right? So there's a priority. And if it's an alt strategy, you just got to be getting in front of the qualified buyers and as many of them as you possibly can. Big funnel, right? Law of large numbers. That's how we approach it. Okay, so there's the next, when we're talking doing more with less, quarterly conference call. For an emerging manager, for the most part, larger firms do quarterly calls. I'd say it's hit or miss with emerging managers. And I'm going to tell you, this is your single best leverage point. And do you want to talk about why that is a little bit, Andrew?
Yeah, well, one, you're constantly touching the clients you have, but also it's basically free marketing every 3 months, where you're sending out an email, you're providing insight, an allocator that maybe didn't take your meeting last time because they weren't interested, you were still getting a chance to hear from you and your portfolio management team on a quarterly basis. They start to see the consistency with which you tell the story, with which you talk about performance, attribution, and so it's basically free marketing and process oriented around it as well.
So you're sending 5 emails a quarter to get them to register. So they're seeing your brand, very important, which I love. You're able to do your prepared remarks in that, right? So you can literally tell, you have the opportunity to look extremely smart in a prepared way because they're not asking you questions for your first 20 minutes. The Q&A comes after. So you're able to tell your audience exactly what they want to hear. And then let's talk about content, right? Because once the quarterly conference call is over, or the webinar, you send the replay link, you transcribe it, which we see typically they view the transcription more than they'll view the replay link. And then you do an abstract of what occurred during that call. So if they just want to scan quickly about what you covered and everything. And then you put all of that on your website. So you're creating all of this content and then historical content. And we have seen a lot of due diligence analysts like to go back and see prior transcripts and replays of going back in time. And that's another thing, because they also like to go through your pitch deck and watch the slides that you covered, which is, again, very useful to establish consistency. And that was probably one of the more surprising things that we've seen, is how they like to go back historically into the calls, right, just to maintain that level of, to see that we're maintaining consistency.
Which, to that point, is important. We like our managers to keep the same format, how they go through the information. 2 minutes on the front end, reminding people on the firm and process.
Right.
Even though it's repetitive, we even hear from our own clients that have been with the firm many years, oh, that's always helpful to hear again.
Absolutely. And we have, if you would like, we have a ebook on how to do a quarterly conference call. So like I said, it's free, it builds your brand, and then also every single client or prospect that you have and you do your quarterly conference call, you're actually helping them, because then they're going to take that information and report it back to their clients.
Exactly.
And again, remember we said do more with less, and it's free. There we go. We can send you the webinar ebook for the quarterly conference call. So we're going to close with what we believe is the biggest leverage point for a salesperson in fundraising. So there's a lot of information that you gather. If you simply can get the meetings that you scheduled into your database, whether it's Salesforce or DealCloud, whatever you might use, Dynamics, if you can get those meetings that you've scheduled, you can do what we call past activity reports. Now, I know this sounds, again, simple, but if you're not getting the meetings that you've scheduled and they stay in an Excel spreadsheet, or they stay on a yellow pad of paper, a sticky note, or they just stay in your head, or they stay on your calendar, right? You're not able to run past activity reports that generate sales ideas. So you look at your past activity, oh my gosh, I haven't followed up with this person for 60 days, 45 days, 6 months, whatever it might be. I mean, think about what we do, Andrew, and the level of just that simple activity, the impact that it's had on our business.
Yep, and time flies. You in your head might think, yeah, I just met with this person. You look in your Salesforce, right. It was over a year ago, right?
Yeah.
So it's really just a precaution on yourself, just to make sure you're not forgetting about things.
And our team lives in our past activity reports to gin up and to trigger sales ideas, to trigger sales actions. And all you have to be able to do is enter the meetings that you've scheduled. And then, sort of to wrap up, as it relates to this, you'll share past activity, but you also, from this, you'll create opportunities from anybody that you have this activity with in your Salesforce, and you can instantly print out a scorecard, if you will, an opportunity report for those meetings with your boss on a weekly or bi-weekly basis. So with that, we have a few more. Are the quarterly conference calls also recommended for alts? 100%, right? I'm just telling you, it's Edgewood Management, our large cap growth manager, large cap growth. We just got 400 participants on our latest quarterly call. I mean, the level of brand building, I can't even tell you. And remember, it's free, which is really great.
And And on the alts, you're always going to have something to talk about of relevance, even if you may have acquired a new company, a new property. People want to hear from you.
Yeah. So question is, how much money on average has Dakota raised for emerging managers? Considering we've never worked with a non-emerging manager, right around 30 billion, depending upon where the stock market is. What is the difference between Dakota and the traditional placement agent? We don't act as a placement agent. We bolt on to the firm as if we're employees. We treat it as if we're employees. So we're really an extension of the firm, and we're there systemically. So not only do we raise the money, we do all the client service. We do all the client service that a salesperson does. Then also Tracy Rogers in office does all the client service work, the database work, all of it. So we act as an extension of someone's firm. That's why we only can work with right now about 6 firms, because it's very, very time consuming to do the work that we do. But we have found that we have relationships that go 16 years, 11 years, 8 years, 5 years. So we tend to stick with our managers for a very long time. And kind of to wrap it up, so Andrew, any closing thoughts? I know we talked about emerging managers, consultants. We covered a lot on this.
No,
all right.
All good. Thanks for listening.
So I'd say the most important thing as we talk about what emerging managers, if you're doing these things, we consider this all part of our entire sales process. We believe sales process wins the day. There are no shortcuts to fundraising. There's no money tree in the backyard where you can go shake it and there's low-hanging fruit and we hear all that stuff. That simply doesn't exist in the fundraising world, because you're asking people to take career risk. That's why if you have a defined sales process that you can follow consistently, and you do all the things that we just mentioned, then you can get to that 2x, 5x, 10x as a salesperson. So everyone, thanks for the questions. Thanks for joining. And we'll see you for our next show on December 4th. Episode 4 on December 13th at 1 p.m. Thanks so much for joining. Hello, everyone. Just wanted to say thanks for watching. Hope you enjoyed the show. One thing that I think you do know is all of this information that we covered exists in Dakota Marketplace, our institutional investor database. Even this show that we just cut will end up in Dakota Marketplace so you can view it. And if you're not a member, we would love to show you the platform. Just simply go to our website and get a free trial of Dakota Marketplace.